we can say that this candle which is forming, which may be possibly a valid entry result, we will have to wait for the bar to close, but it's becoming a long bar. When we compare its length with the length of the two previous blue candles, we can immediately see that this is a long bar. So this is not an opportunity to consider. We will have to wait for another opportunity. So for the moment, the only good opportunity we have is the pound yen, for which we are already in the trade. Okay? And so now let's focus on the pound yen. We can see that like the pound US dollar, the bar which is printing now becomes a long bar. And when you see that, don't hesitate to write on the chart long bar. There is also an indicator for that. And you know that a long bar is an exit setup bar. And we can evaluate even if we will have that candle to close now. So we'll have to evaluate quickly its length. It's 17.5 pips. 1/3 of that will be 5.5 pips. So here at 5.5, I will have to set my exit setup if the price retraces enough. So 5.5 will be right in this area. Okay. And so if the price hit that level, we can make an MX with some profit, here a profit of 8 pips, if you decide to apply all the exit techniques. And so let's wait for the price to hit that level. And so we can draw the line here, that way. And the price is touching the level. So here we can click on the button to make an MX, and so we can write here an MX number 1. And then we can write on the chart. So first of all, the setup was clearly a safe and perfect move, so it was a short safe and perfect move. Then we have made an MX. That MX has closed, you can see here, let's say 8 pips minus the spread, which is 1 pip, so 7 pips, so we have plus 7. Can we adjust the stop loss? No, not yet, because the max price channel is here. But we are still at risk on this trade, of course, because we have banked a small profit on the MX, so only 7 pips, net pips, and we still have a risk of 19 pips on the second unit. So the total risk now becomes 12 pips. So we have a risk of only minus 12 pips on this trade. And now our aim is to try to decrease that risk with the price continuing to evolve, either in our favor or against us. But now we have the question to close the second unit. And when we have to close the second unit, we have to make a choice. And we have basically 2 choices to close the second unit. The first choice is, and I'm going to write it, for example, here, first choice, on the next exit setup. We can close the second unit on the next exit setup, which does not appear in the same time window, of course. And the second choice, and sometimes we will have no choice, the second choice will be on the ETF trend reversal or on any form of the movement invalidation. Okay? What is the movement invalidation? The movement invalidation is when I can display on my chart the IZ line. I don't think I have it on my template. Let's check that indicator list. I don't have the IZ line, but I can add the IZ line. Max IZ here. And the IZ line, you can see it's that magenta dotted line when it appears. So it will appear in this downtrend above the Moore line. And the movement invalidation area is that area between the Moore line and the IZ line. We don't have it here for the moment. So the only possibility for the movement invalidation is for the price, in fact, to hit the stop loss or for the trend reversal. So here we have no choice, or if the price resumes the downtrend, so the next exit setup. And now we need to be patient, so in order for this trade to complete. In the meantime, we can check what is happening on other pairs. So nothing on the euro US dollar, nothing on the pound Swiss and on the pound US dollar. We need to wait for a retracement deep enough to cancel the effect of the long bar, and pullback deep enough is a pullback at least touching or crossing the ETF lines, and then nothing on the pound Kiwi and the pound Aussie because we are waiting for a short entry setup. Now, concerning the movement invalidation, there is another way to consider the movement invalidation. If you remember, we have what we call a pseudo IZ level at mid-distance between the entry level and the stop loss. We have a distance of 19 pips, so half of that will be 9.5 pips, and 9.5 pips will be right here on this level. And so this is another way to define our IZ level. And so if the price comes back and hit that level, we will close the second unit with a small loss, in such a way that the total trade will be either break even or with a small profit or with a small loss. Because the aim is to always minimize the risk we have on the trade. Remember, the stop loss is an emergency stop loss. It is there to protect the account in the case we are not able to handle the trade. And the aim is to never leave the price hit the stop loss. And so the IZ level, when the IZ line does not appear, you can see the IZ line does not appear. There are reasons for that. So the pseudo IZ level here has the aim to consider the movement we are trading makes no longer sense because we don't have the confirmation that the downtrend is resuming. For the euro US dollar, my bias is still long, so as soon as I will have a long entry setup, I will consider that long entry setup. Concerning the pound Swiss and the pound US dollar, we can see that now the price has reached finally the ETF line, so we have a pullback deep enough. And if the price resumes the down movement and we have a short entry setup, I will consider that short entry setup. And I ignore the pound Kiwi and the pound Aussie because the price is not moving in my bias direction. And never be afraid by these kind of pullbacks that widen the pound yen pair. Never be afraid of that kind of pullbacks. That always normal that the price makes pullback when a trend begins to develop. Look this trend here, this downtrend. We have small pullbacks, we have deeper pullback, we have small pullback, deeper pullback, deeper pullback. And so the pullback are natural movement inside a trend. And this is why you need patience and discipline. And we can add also and courage. And with the long bar here, we were expecting, in fact, a pullback. And the pullback has been made. And now it seems that the price is coming back. If the price now succeed to go lower than this low, here we will be in a different time window. And so we will be able, for example, to close this trade on the next exit setup. If you have questions, of course, feel free to put your questions in the chat seat, and I will be glad to answer any of your questions. Now, because we have made the MX on the long bar, with the long bar rule, you can see that here at the close of this blue bar, most probably we will have a bottom in an actionable big bottom in the store RSI, but because we are in the same time window, we will ignore that exit setup. I remember you that we make only one exit per time window. The time window being all the bars making the bottom or a top formation. So nothing is happening for the moment on the other pair, so we can still focus on the pound US dollar. And you can see here, despite the fact that the price is going upward for the moment on the pound US dollar, on the pound yen, so the max price channel begin to progressively drop. This means that if this continue as long as we will be in the trade, we will be able to adjust to fine-tune our stop loss. If we have another opportunity, I will illustrate the trade with the MTM, so the max trade monitor, which handle some aspect of the trade risk management in a very nice way. For example, it calculates automatically the size of the trade depending on the percentage of the trading account we have chosen, 1%, 2%, and depending on the size of the stop loss. Now, in the worst case scenario, we already know what will be the result of the trade. We have made 7 pips on the first unit, and we will lose here, let's say 9 plus 1, 10 pips on the second unit if the price hit that IZ level. So minus 10 plus 7, we will lose 3 pips. 3 pips representing a neglectable rework to risk ratio. So minus 3 divided by 2 times 19 or 38, this represents minus 0.08 R. Minus 0.08 R. So a real neglectable loss. This means that you should normally feel comfortable on that trade, whatever the price will do. Okay? Noor asks, so can I just check? The signal bar had 7 red windows when we enter the trade. It turns to 8 as the bar develops. Does that mean there is flexibility if 7? In fact, remember what are the tumblers at our disposal Noor, when we consider the max primer. We have the signal bar, we have the store RSI, and we have the fast bias. So we have 3 tumblers, okay? Now, the store RSI was in agreement. The fast bias was in agreement. Even if the signal bar was not in agreement, we had 2 out of 3 of our tumblers in agreement. And so we had enough tumblers to consider the setup was a good setup. Because remember, at the beginning of a new trend, so the fast bias must be in agreement. We don't need to have all the tumblers in agreement, but just a majority of them. And this is why we always try to have an odd number of tumblers, because a majority of an odd number will be always clearly defined, in fact. A majority among 3 is always 2 or 3. A majority among 15 is always 8 or more. So it's easy to consider when we have a majority of tumblers. The euro-US dollar is still not giving a setup because we have to wait for the slow burst to change to green. And we have here possibly an entry setup forming on the pound US dollar and possibly one forming on the pound Swiss. I like the pound Swiss. And see, it's not because the price has moved already by a nice number of pips that we have to consider that this setup will be a dangerous setup. But is it a valid setup? We have, so here, the ETF line having crossed downward, the Stochastic RSI is downward, the fast bias is downward, and we have a vast majority of red in the signal bar. So this candle is a valid entry setup. However, you can see that the entry will be close to the low of the previous long bar. So it's not a good entry. It's a very risky entry. So I prefer to wait for a better opportunity. This means that the pullback has not been deep enough, and unfortunately, the close of the setup bar is too low, giving an entry setup, a short entry setup, too close to the extreme of the previous long bar, which is never a good position to open a trade. And so I will skip this opportunity, and never mind if the opportunity would have been a good one. So because we want to take the safest trade, in fact. On the pound US dollar, let's see what we have. We have a more favorable entry, but yeah, the Stochastic RSI is not in agreement, but we have a majority of the other tumblers so in agreement. So I will not have time to set the MTM, unfortunately. So the entry would have been there somewhere here. You see, at 2 pips. So 2 pips is right here with a stop loss. So here on this level, giving a stop loss size of around 20 pips. Yeah, 20 pips because we have almost no spread on the pound US dollar. So we can write here ESL 20 pips. And so my advice is never try to make more than 2 trades simultaneously. And so once you have your 2 trades, what you can do is you can iconize all the other charts. And then you can retile the 2 windows. Now, for the pound US dollar, we are in a choppy mode, so we will have to pay attention to the way to handle the trade, okay? And so we have here, again, also a safe and perfect mode. So short ETF, safe and perfect mode. And we are in a choppy mode. And I like to mark on my chart choppy mode, not to forget that we have to handle the trade in a very, very careful way. I'm going to illustrate. And this is something I will illustrate more in details in the bonus session we will have Saturday. Now, concerning the pound yen, we can see that our stop loss is at a distance of only 3 pips from the max price channel, so it's advised now not to adjust the stop loss. It's a little too early. It's good to keep a distance between the stop loss and the max price channel between 4 and 6 pips, depending on the volatility of the pair, depending on the volatility of the moment. Concerning the pound US dollar, we are at a distance of 5 pips, so we have also a good distance here. If you want to have some more clarity in the Stochn RSI, because of course the Stochn RSI may give also exit setup, you can widen a little bit the window of the Stochn RSI. And you see, it requires patience to wait for the appropriate setup. What is the thin yellow line? You mean this one, Robert? This one? It is the Mo line. It's the 21 exponential moving average with a shift of 3. It's the Mo line, which helps to define the price mode. You can see because the Bollinger Band are expanding, because the price is going downward, because the Mo line is going downward, the local price mode is a trend mode. It's also a trend mode in the pound US dollar, but the global mode is the choppy mode for the pound US dollar. Now we have to pay attention, because if this candle closes as a blue bar, most probably we will have an exit setup on the pound, on the Stochn RSI for the pound yen, but also for the pound US dollar. Okay? And the candle closes in around 4 minutes. No, the thick yellow line and orange line, dark orange, are the ETF lines. Now, in the case of the pound yen, I have illustrated, so taking the MX with the first exit setup. In the case of the pound US dollar, I would like to illustrate my discretionary decision, but because we are in a choppy mode, I will not do that, because by definition, when we have identified the choppy mode, we are pretty much sure that the price will stay in the choppy mode for many more bars. I can also draw on the pound US dollar where is my IZ level. So it will be at 10 pips. So here 10 pips will be around, oh, I'm lucky. It is exactly where I have drawn my horizontal line. So here I will have my IZ level where I will consider that the trade is invalidated. The PC line, no, not the PC line. I don't know what is the PC line. No, we have not changed the color, Robert. The price channel, or sometimes in some of my templates, the price channel is blue, on some other it's orange. It doesn't mean, so I can redraw it in blue, Dodger blue, in fact, but it doesn't matter. So Dodger blue here. Okay, and this one also, Dodger blue. No, the other one here. Okay, is it better that way? It depends on the template. On some templates, my max price channel is blue, on some other it's orange. So in 40 seconds, this candle will close. And so we will have to check if we don't have here an exit setup with the pound, US dollar, and the Stochn RSI, as well as with the pound yen. So what I'm going to do is I'm going to prepare a vertical line in magenta, this way, and here too. So the candle has closed, and indeed we have no exit setup in the pound yen, but we have an exit setup in the pound US dollar. So I will define my exit level 3 pips above here at 207. 207 will be right on this level. So if the price hit this level here, this will be my MX level for the pound US dollar. There was no bottom in the Stochn RSI, so no exit setup for the pound yen. Because the max price channel is flat on both charts, I cannot adjust further my stop loss for the moment. It seems that the price wants to resume the down movement, which is fine. So we know that we have now an exit setup with the Stochn RSI. We have even a divergence. We have not only actionable big bottom, but we have also a divergence because we have higher lows in the Stochn RSI and just lower lows in the price. And so this means that here we have our exit level. If the price doesn't hit that exit level, it will stay valid until we get a better exit level. And precisely if the price closes as a red candle, meaning that the price is resuming the down movement, we will have to check that we are not in the ratchet condition. But for that, we need to wait for the close of the bar. Now, with the momentum we are seeing in the price movement, the odds to have a ratchet condition is extremely low. And in the meantime, we can write on the chart so our notations. And so most probably we will have a no MX here. How much time is left? So 2 minutes for the bar to close. This may become a long bar. What is its length for the moment? It's 13 pips, but this bar is 8.5 pips. This one, let's say 6 pips. This one, oh no, it's not yet a long bar. No, not yet, because the distance between the max price channel and my stop loss is still only 3 pips. So it's too early to tighten my stop loss on the pound yen. But what you can consider is also the following. If you want absolutely to reduce the size of your stop loss, wait for the candle to close. And then let's suppose the candle has closed here. and you measure a distance of 19 pips. So here 19 pips, which is the size of the initial stop loss. And so this means that you can, in fact, it will be around this area, you can adjust your stop loss anywhere between its initial place and this distance of 19 pips. But for me, it's a little too close to the price. I will never set my stop loss below the Mo line, at least for the moment. It's a bit too early. But now we have an interesting situation because we can see that on both charts, the bar becomes a long bar. We can eyeball that. And the long bar will give an exit setup. And so we have the choice to close the pound yen on this exit setup. And so let's prepare. So here we have, let's say 5.3. 5.3 will be somewhere here, a little bit higher. And on the pound US dollar, it will be, so 5.5 to 5.5 will be right here. Yeah, we don't need to be absolutely accurate on the pipettes. So on the pound US dollar, I have here my exit level, and on the pound yen, my exit level will be here because again of long bars. Okay, and so the price hit. So here we have an x66. So x66 on both charts, by the way. x66 on the pound yen. And this is where using the MTM it's easier, and only an MX on the pound US dollar. Okay? Now, let's calculate the result of the trade on the pound yen. On the second unit, we have made a profit of 21 pips. So plus 21. Plus 20, let's deduce the spread. And on the pound US dollar, we have a spread of almost zero, so we have a profit of, let's say, 11 pips, so plus 11. So the trade on the pound yen is closed. We have made a decent profit here. So we can see trade, let's say trade number 1, plus 27 pips, with an ESL of 19 pips. So this represents a rework to risk ratio of, we divide 27 by 2 times 19, so 0.71 R. Okay? And now for the pound US dollar, we have to pay attention. Remember, we are in a choppy mode. And the profit has been a rather small profit of 11 pips. I will give more details in the bonus session how to handle the trade in a choppy mode. But here we are in what I will define as the scenario number 2. And in the scenario number 2, we have to adjust the stop loss at a distance above the entry level, equivalent to the profit we have made on the MX number 1, in such a way to set the entire trade at break even. And so my entry was here. 11 pips will be somewhere here, but I want to take into account the spread. So the spread is almost 0, and I want to be break even plus 1. So now I will adjust my stop loss right on this level, which happens by coincidence to be my IZ level. And so I will set my stop loss now. So this will be my stop loss. Okay? In such a way that if the price hit the stop loss, the loss on this unit will be 10 pips. But I have made a profit of 11 pips on the first unit, so I'm break even plus 1 at worst on this trade. And this is one of the scenarios we have to apply when we are in a choppy mode. But more details, so Saturday, with the different scenario we have in the choppy mode. Of course, in the meantime, if the price resumes the down movement, and I have an opportunity through the max price channel to adjust my stop loss below this stop loss now, then I will improve my trade on the pound US dollar. Okay? And because I have made here the stop, the DMX on the long bar, because we had a long bar here, I will ignore, of course, later the exit given by the store RSI should the store RSI make another bottom with this bar here, because we are in the same time window. Now concerning the pound yen, so we will wait for another opportunity in the same direction, so short trade. And you see here, I don't know what the price will do. I simply apply the rules. I don't try to guess what the price should do, must do, could do, will do. I simply apply the rules. But this requires, of course, to master completely the rules and to be able to recognize at a glance when a rule applies, and then to go fast to apply the decision associated with the rule. And when you have some time, you can annotate your chart. For example, here we had no MX, okay, with the divergent in the store RSI. Then we had this bar, which was also a setup bar, a long bar. And now we wait for the next exit setup. Still in the pound short from about this time yesterday. Oh, great, Craig. And this now is developing an interesting situation. We have made a profit on the first trade. We are at worst at break even on the second trade. But now we are seeing a good situation developing. The max price channel begin to drop, and it's close to our new ESL. When the max price channel will drop below the ESL here, we will be in a more favorable situation, because whenever we will be able to adjust our stop loss, we will lock more profits on this trade. But of course, we have not to forget the fact that we are in the time window here, so the next exit setup must be ignored, except if it is a long bar, because a long bar is always an exit setup. And so if we have a normal exit setup, we can ignore it and wait for the next one. And this requires, again, patience and discipline and courage. Never be afraid by the fact that along a pullback you see a portion of your profit disappearing. Another way is, as I have said here, on the pound yen, is to wait for the movement invalidation or for the ETF trend reversal. You can always wait, especially when you are risk-free, and this is the case here on this pound US dollar trade. We are now risk-free due to this stop loss. We can try to stay in the trade as much as possible until the trend changes direction. Any questions about what I have presented here during these two trades? And I said time is flying very fast, so in 3 quarters we will be at the end of this workshop. So we are here for more than 1 hour and 1 quarter now. I don't know for you, but for me time is flying. Now, concerning the pound yen, we are waiting for a remo because we have closed the trade, and so in order to have another trade opportunity, so we need to wait for a remo. This means that we need to wait for the price to make a pullback, at least touching the ETF lines, and then the trend resuming, of course. Now, when we widen the chart for the pound US dollar, we know that the pound US dollar is in a choppy mode, and we can see that the price is making an attempt to leave the choppy mode. But pay attention, it's not because we have the breakout of this choppy mode that the price is leaving the choppy mode. The price can make some movement and then come back in the choppy mode. Because typically the choppy mode has a number of bars comprised between 100 and 200. So it can last until this moment, in fact, even after the London close. And this is where it is important to always know what you can expect from a price movement in order to better handle your decision when you have to decide where to close your unit. And in the meantime, when you have some time, some flexibility, some free time, you can always check. So on your Forex Factory news page, you update the page and then you check if there is nothing new. There was some recovery in UK. Expect a choppy summer. This is an opinion, so I don't care for that. So nothing important for the moment which can influence the market sentiment. So. And that we wait quietly, calmly, without stress, because there is no need to have some stress. We have a guarantee to make a profit. Remember, with a 2% risk, this represents a 1.4% profit. Even with a 1% risk, this still represents a 0.7% risk. And remember, if you are able to make every day, if you trade every day of the year, every day, and you are able to make on average 0.5% per day, 0.5% per day, and you compound your profits at the end of the year, you multiply your account by 3 if you make no withdrawal. Now, in the context of the pound yen, are we in a true trend situation? So we can see that here we were at the US Open, and the trend for the moment is a movement of 46 pips. So we are not in the context of a true trend. We need to see a movement of 60 pips or more. Double bottom, Robert. Indeed, and not a surprise to see an exit setup appearing here, okay? It seems that Robert is obsessed by the double bottom and double top. This blue candle closes in 2 minutes. Chances are small that it will give an exit setup in the store RSI, but even if this is the case, we will ignore it because we are in the same time window as our MX due to the long bar. How do you evaluate initial macro bias? This is a long process. This is a long process. So I take approximately 1 hour every day in my preparation daily routine to understand what is happening around the world, which may influence the market. Then, so I check the headlines of some websites, for example, as I have said earlier, Reuters, Bloomberg, the Financial Times, the Wall Street Journal, Forex Factory. to see how the geopolitical elements we have on our news watch list will evolve. And for the moment, I see nothing very special. Then I evaluate the news of the day, and we have had 3 news on the pound earlier today with the GDP, which has produced no surprise, so no reason to change the bias. Then we had the ZEW on the euro, which has been positive for the euro, so making the euro a bit stronger. And now we had the CPI on the US dollar, which was just a little bit positive, but not enough to create a big surprise. And so I consider also a multi-time frame approach on a technical point of view. So I don't only consider the macro fundamental, the macroeconomic factors, the geopolitical factors, but also what is happening on a multi-time frame approach on all the pairs or the instrument I'm considering. And based on all that, I define my directional bias. And so it's a process which is rather complex to explain in a few minutes, because it takes me around 1 hour every day before I consider to observe my chart, waiting for a setup. Yeah, it can be learned. Indeed, it can be learned. And I explain the important points. In fact, in the Max ETF Standard course, in the session, I don't remember in which session, when I go deeper into the geopoliticals and into the news release. No, I'm still working on the fundamental course, but I have some other higher priority for the moment. So, but the fundamental course will contain all these points, indeed. You can see here for the pound yen, so the pullback has not been deep enough, unfortunately, so we still have to wait. Of course, with the Max ETF standard, we would still be in this trade through the scaling process. Now we are seeing in the pound US dollar that the store RSI will form a certain W with at least 2 legs. And now we are seeing something interesting. You see now the max price channel is going below our stop loss, but the distance between the stop loss and the max price channel is still too small to consider adjusting further our stop loss. But what may happen now is this candle may become possibly a long bar. We have to ignore the previous long bar to evaluate the length of this one. So we will take only these 3 bars, the 2 red and the blue. And so we will have an average length of, let's say here we have 5.2, 5.7, 10.9. Oh, it is definitively a long bar. There is no need to evaluate it now. We can eyeball it is a long bar. And a long bar must always be an exit setup. And we can already begin to, despite that we have still 2 minutes, we can begin to define where to make our exit level. So we have 13 point, let's say 13.5. 1/3 of that will be 4.5 pips. So 4.5 pips will be right here in this area. Yeah, we are in this area. And if the price push further downward, we will readjust this exit level. We are in the same time window, but with long bars are always excellent opportunity to bank a profit. And you will see why if this happens. Let's draw the level that way. And indeed, you can see the price has hit the level. So here, we can decide to make our XXX. Despite the fact that the price has not, the candle has not closed. So XXX here, okay? Now, another alternative way to make your XXX on a long bar is to wait for the long bar to close, because we are left with 1 minute, and in 1 minute the price can push further below. Okay, let's see that. Let's set this horizontal line on the low of the candle to see if the price will push lower. Anyway, I have decided to make my XXX here. You know that for the long bar rule, you can decide to wait for the bar to close or to make your exit in live conditions. And we will see the difference. You see, for the moment, the difference is a very small difference. Very small difference. So you would have gained perhaps 1 pips. Yeah, 1 pips. Which is not a big deal here. But sometimes 1 pip can make a difference. And on this XXX, we have made a profit of here, we can see 26 pips, so we can write here plus 26. I always count a small slippage. The candle will close. You see, making the XXX live in real-time condition has not been bad. There is some volatility. I would have made a better result of around 1.5 pips perhaps, but it doesn't matter. So the trade is closed here, and we have made here a nice profit of, so trade 1, for example. So we have plus 11 and plus 26, so plus 37 pips. The ESL was 20 pips. And so the rework to risk ratio is we divide 37 by 2 times 20. This represents plus 0.93 R. Okay? And you can see that with these 2 trades, in just 1 hour, we have made a total of 1.6. If I add the 2 trades, the combined result is plus 1.64 R. This means that with a 2% these 2 trades represent 3.2% profit on the account. And with a 1% risk, it represents a 1.6% profit, which is not bad for the max primer. Okay? And so you see the importance of combining everything, not only the technical aspect, but also the global context, when we have an understanding of the global context. I knew in advance that my bias should be short for the pound yen, short for the pound US dollar, and so I have taken the trade in agreement with the short bias, and you have seen that almost immediately after the entry, the price moved in the right direction. Of course, had I a guarantee that the trade would have been closed with a profit? No, not at all. Look at what the price has made after the entry. The price has made a pullback, and this kind of pullback in the case of a high volatility can make the trade, can force me to close the trade with a loss. But it will be always a small loss if we use the concept of the movement invalidation. But if we have not such a volatility, we have a very high percentage that the trade will end as a profitable trade. Based on my experience now of many months with the bias, when we take the trade in agreement with the bias, we have a winning rate of more than 90%. No, I'm not concerned with reward to risk ratio less than 1, simply because we have a high winning rate. Thomas, let's make the following expectation calculation. So here, we know that when we combine the max with the bias, so the directional bias, we have a probability for winning which is around 90%. Let's say 90%. Okay? This means if I ignore the break-even trade, this means that my losing rate will be, let's say, 10%. In reality, it is less than 10% because we have approximately half of them being break-even. Now, when we make a profit with the max ETF primer. The profit is usually between 0.5 and 1 R. These are two typical example of winning trade. Let's be pessimistic and let's consider that the profit will be, so the reward to risk ratio will be just plus 0.5 R, okay, in the case of a winning trade. And it happened that when we have a losing trade, the loss will be in general less than minus 0.5 R. But let's be pessimistic and let's consider 0.5 R. Now, when we calculate the expectation, what is the expectation? The expectancy, it's the winning rate times the average profit of winning trades minus the losing trade times the reward to risk ratio of the losing trade. And so here we will have an expectancy, which is written E, capital E, equals 0.9 times 0.5, that way, minus 0.10 times 0.5, okay? And if we make that calculation, in fact, we obtain what? What do we obtain? 0.4. So our expectancy is equal to 0.4. So the expectancy equals 0.4 R, which is a positive number. And this is what is important. We need to have a positive number. And the fact that the reward to risk ratio is less than 1 may be a problem if the winning rate is too small. But when we have a very high winning rate, it doesn't matter if the reward to risk ratio is small. What is important is the expectancy. This means when you take, for example, 200 trades, on 200 trades, your average result will be around plus 0.4 R. Okay? It will be a plus here, positive. What does this mean? This means that if you make 200 trades, for example, you can expect to have a total profit on 200 trades. The profit will be what? It will be 200 times plus 0.4 R, or, so this means equals to plus 40 R's of profit. If you know your expectancy, you can evaluate in advance what your future financial result will be. If you take, for example, 200 trades, you can expect to make not a minus 40 R, but a plus 40 R, of course. Plus 40 R's. This means that with a risk of 1% after 200 trades, you should make a 40% profit on your trading account. With a 2% risk, you should expect to make around 80% profit on your trading account with 200 trades. Okay? Are you familiar, Thomas, with the concept of the expectancy? Okay, fine. So you understand what I have explained so here. And so what is important when you compare two trading systems? There are two factors which are extremely important. It is the expectancy, and so the expectancy, you can have an evaluation with a large sample of trades, minimum 200 trades, better 500 trades, in order to have a good idea of your winning rate, losing rate, average profit per winning trade, average loss per losing trade, in such a way that you can evaluate your expectancy. It will be a good evaluation. And then if you know that you make, for example, 200 trades per month or per quarter, you will have a good idea of your financial performance over that period. So the expectancy and the frequency of the trade are the two important factors when you compare two trading systems. And in fact, it is the product of the two which will give you the best criteria to evaluate the best trading system. The best trading system is not necessarily the system with the highest winning rate or with the highest expectancy, but the highest expectancy times frequency. So not bad for 1 hour and a half of work. It is a time period well paid. I don't know for you, but for me it's a good time, well paid. Should this be two real trades, of course. But I have marked my chart in live conditions, so I have not cheated, as you have seen. And so, but I have tried to apply the max process, the max trading process, as clear as possible without no ambiguity, always explaining in advance what I would make, what will be my decision. And you can see that finally it's not so difficult to apply the process. Of course, you will have losing trades. You cannot escape losing trades. But if you handle the trade correctly, as I will illustrate Saturday for the losing trade, a loss will be always a small loss. And now we can see that the movement on the pound yen is a movement of more than 60 pips. So we are in the context of a true trend now. In the pound US dollar, we have a movement of almost 60 pips. Yeah, let's say we are at, for 1 pip, we are in a true trend. And when we are in a true trend, provided the price does not make a too steep angle, which is not the case yet, so we can expect this true trend to exhaust inside the red magic box, which starts half an hour before the Frankfurt close. So half an hour before the Frankfurt close, and which ends half an hour after the London close. So we should expect this trend to resume and exhaust inside that 2 hours time period. And similarly for the pound US dollar. And so this showed how the preparation of your trading session is important. So prepare well in advance all your chart, taking into consideration all the factors which may influence your trade. And so I repeat, so first of all, choose the best promising pair. We are never sure which pair will move the best, but at least if you choose the pair among the pairs we suggest every day, so you will increase your odds to have nice movement. Then draw on your chart these important vertical lines which represent the open and the close of the important session. So the Frankfurt Open, the London Open, the Wall Street Open, the New York Open, the Wall Street Open, the Frankfurt close and the London close, and draw also on your charts the important news release in such a way to never forget them when you observe your chart, and prepare all the charts you want to monitor well in advance in such a way that when you consider to begin trading, all your charts are ready and you know in advance what to do. Take into account the bias. If you are able to define the bias yourself, that's nice, because this means that you will become completely independent. If you need some help at the beginning, so consider to subscribe to our max advantage bias, where I give the bias in live conditions, and when I change them whenever it is necessary to change them. My aim is to be around 80% right with all these bias, and when we take the trade in agreement with the bias, my aim is to have a winning rate of 90% or better, which is what I observe for the month for many months now. Despite the fact that we have difficult days, because days are very often choppy days. We don't have extraordinary movement in the market nowadays due to the COVID and to the problem this COVID is creating everywhere around the world. So the economies are stopped, paralyzed. We will face a very important economic crisis, perhaps a financial crisis, to perhaps a monetary crisis. We never know what may happen, but times will be difficult in the future. And if you understand all these factors, you will increase your odds to be profitable in trading. So, okay. Let's have a quick look on the other charts. So I will retile all my windows here. Tile window. Oh yeah, I have of course to make them. I must not iconite them. And let's retile the window. And let's see what the other pairs have meant. So the euro US dollar. My bias was long, and we can see that after the news, indeed the trend is reversing. Okay. The pound Swiss. My bias was short, and the price indeed went short, but we had a long bar and not a good entry level on the second setup. So we have missed this trade, but it's never a problem when we miss a movement. The pound US dollar we have handled the pound US dollar. The pound Aussie, my bias was short. See, not good entry setup, too long bar, so. And on the pound Kiwi, here the price stays in a nice choppy mode. My bias is still short, but as long as the price stays in this choppy mode, the pound Kiwi today will be a very difficult pair to trade. But anyway, no entry setup for the moment because the slow bias is not in agreement with the global context bias. And so you see two nice opportunities and two nice trades. You see? And so when you evaluate your chart, so don't focus only on the local price mode, focus also on the global price mode and choose to trade in priority the price which are not in a choppy mode. If you have no choice, of course you can trade a pair in a choppy mode, but if you have the choice, I have illustrated that with the pound yen. The pound yen was not in a choppy mode, and so this is why I have taken the first trade on the pound yen. Then another opportunity happened in the pound US dollar, a nice opportunity, but in a choppy mode. Knowing that we were in a choppy mode, I knew how to handle the trade in the choppy mode. You can see here, remember what I have said. At this point, we may have the impression that the price was leaving the choppy mode, but remember what I have said. The price will most probably come back inside the choppy mode, and this is what the price is doing. And the choppy mode will last probably until the end of the day. Okay? And so you have to keep in mind this general behavior the price is developing, because they will help you a lot. They will help you a lot. And a few years ago, I have made a Max mini course, which is called the typical intraday movement. You can buy that mini course. The price is really cheap. I think it's $49 only. It's a 2 hours or a 3 hours course, and which explains some of these general behavior the price is making, and they can help you to understand why sometimes, purely on a technical point of view and statistical point of view, why the price is moving better in one direction than in another direction. And this can be an excellent introducing to the more complex approach of the general context, which takes into account many more political, geopolitical, macroeconomic, and fundamental elements in the analysis of the context. So we are left with around 12 minutes before we wrap up this session. Any questions? Any comment? I hope you have appreciated the show. Oh, your question above. What is the question, Thomas? How much the bias is relevant on higher time frames? Ah, that's a good question. Okay. Let's go on the bias sheet here. So this sheet it gives the short-term bias. You can see that the title of the document is short-term bias. But it's an Excel sheet, in fact, and it has two sheets. The first sheet is the short-term pair bias, and the second sheet is the long-term bias. And every day I also establish the long-term bias. So for the 28 pairs plus the 5 indices, gold, crude oil, and the US Treasury bond and the Euro bond. And these long-term bias are valid for the 4-hour time frame and higher. The short-term bias are valid for the 1 minute up to the 1 hour, and the long-term bias are valid for the 4-hour daily and higher time frames. And of course, with the long-term bias, in fact, we have to take into consideration more fundamental data. The fundamental data, the macroeconomic data, have a much more important factor than the market sentiment. For example, today with the CPI has a bit favored the market sentiment, so in favor of the US dollar, not so much, but because we had no surprise in the CPI, the long-term bias, in fact, the long-term bias has not been changed by this news release. And so in this long-term bias page, you have also the date when I have updated these bias. Today, for example, there has been no change. Yesterday, there has been some change. For example, yesterday was the 13th of July, and on the 13th of July, I have changed the bias, for example, of the pound kiwi, and on what? So on the pound kiwi only. And the previous day, the 12th of July, on the pound CAD, as you can see. But so the long bias are not changed every day, of course. Let's take, for example, the Aussie CAD. My long-term bias is long. My long-term bias is long on the Aussie CAD since the 14th of April. Let's take the 14th of April. Let's take the Aussie CAD. The Aussie CAD is right. Where is it? Aussie CAD. It is here. And let's take, for example, the 4-hour time frame. I will make a zoom out. And so the 14th of April. 14th of April was right. I'm going to draw the vertical line here. So 14th of April. If I make another zoom out, so it was here. You see here. So my bias was long, and I like to use magenta green vertical line to show my directional bias, and it is not bad, you see, not bad. My bias was long on that moment, and look what trend the Aussie CAD has made in the 4-hour time frame or in the daily time frame. You see, in the daily time, it was a nice movement of around 500 pips, 500 and almost 60 pips. Okay. Or you don't need to necessarily to scan all the markets, Thomas, just begin one step at a time. So begin, for example, to understand the impact of the news in the market. Then when you master the impact of the news in the market, integrate the analysis of the decision by the central banks. And this will help you to better understand why some pairs are better trending than the other. Then add another component, which is the geopoliticals. And when you will integrate all this information, you can analyze their impact in each market individually. Their impact in the Forex, their impact in the stock market, their impact in the commodities market, their impact in the stock market, in the bonds market. And when you will achieve that step, then you will have a global view of all the possible markets and their interrelationship. And when you have a global view of the interrelationship between the market, so step by step, you will have a better idea how to trade effectively, in fact. Do that and watch your win percentage improve. Indeed. Never try to master everything at once, because it's really a huge task. On an individual point of view, it may be a learning curve of 10 to 20 years. But with the help of some teachers, you can go way, way faster, in fact. Okay, Peter, have a good night. Have a good night. Oh, thanks, Noor. Thanks, Noor. Really appreciate your comment. Now, one difficulty we will have for the rest of the day, if I take either the pound yen or the pound US dollar, is we are approaching the red magic box. And so this means that the probability to have a good winning trade will decrease. And so usually at this time, if I don't have, I still have a few minutes, but if at 10 a.m. New York time, I don't have another opportunity, my day is done. I stop my day, because after that, the probability to have a good trade in the absence of clear market sentiment. So because the news have produced no surprise, so the market sentiment is neutral. So there will be no good opportunities. And knowing when not to trade is as important as knowing when to trade. And so for me, virtually, my day is done. Okay. I bank my profits, and I'm happy, and I'm waiting for the next day. I am